Good morning, Rick.
Morning, Sharon. How you doing?
I'm good, dear. I got a question for you. When our folks are buying a home, I'd love you to explain to us the different financing options that are available for a home buyer.
Okay, well, the most popular one is probably the high ratio mortgage, which only requires, in some cases, 5% down payment, that is, sorry.
Right.
So you can actually buy up to a $500,000 property with 5% down.
Mm-hmm.
Then the next level is still considered a high ratio mortgage. And high ratio means that it has to be insured by CMHC, or they've changed the name from Genworth to Sagan, which is the private version of
Right.
CMHC. And then there's also Canada Guarantees. But at the end of the day, they're all the same cost for the insurance. Um, so it's not really that important to the buyer which ones they get. It's more what the lender just happens to use. But sorry, I digress. So yes, the next level is up to $999,999. You need 10% down for the amount over 500,000. So for example, a $600,000 house, you would need $25,000 down payment for the first 500,000, and then 10,000 for the next 100,000.
Mm.
So that would be 35,000 down that you would need for a $600,000 house.
About
So
7.5%.
yes, in that probably,
Yeah.
but
Yeah, that's
something like that. Yeah. So oops, I just went purple. Are you seeing that?
you shouldn't have had that last drink.
Maybe I should have
Last pink
stayed.
flamingo.
Maybe I should have stayed with the outer space background because now I'm looking like an alien. Anyways, yeah, this is a weird effect. So
Oh.
then the next option, of course, is your traditional mortgage, which or conventional mortgage, which is anything where you've got 20% or more down payment.
Yeah.
So when you get into conventional mortgages, we can start doing things like going with longer amortizations and things like that, so you can qualify to buy more. Unfortunately, the CMHC high ratio mortgages are restricted to 25-year amortization.
Right.
So yeah, when you go with a conventional mortgage, we can stretch the amortization out to 30 years, which allows you to qualify to purchase more property usually. Um, then we can get into alternative lenders. That could be like your credit unions or just your non-prime lenders. And when we get into alternative lenders, we can use higher ratios, which just to not get into the complicated math, you can qualify for more again. Unfortunately, they do charge a bit of a higher interest rate, but when you're dealing with alternative lenders, you're much more likely to qualify if you're self-employed or have past credit issues. They'll look at you when a traditional A lender will not. The
Right.
A
Right.
being the banks and so forth.
Yep.
So
Yep.
um, yeah, so that's your basic overview of the different mortgages that are available out there. Um, well, sorry, I skipped a big one. There is also what type of interest rate do you want? Do you want fixed? Do you want variable? Do you want an adjustable interest rate? So a fixed interest rate you get for a set term, usually around 5 years. This gives you the security of knowing exactly how much your payments are going to be for the next 5 years. So a lot of first-time buyers certainly choose fixed. The problem with fixed interest rates is if you need to prepay the mortgage early because maybe you're selling the house, or maybe you need to refinance because you want to do a renovation, or you've racked up your
Right.
credit card debt, any number of reasons. Uh, you have to pay a higher penalty if it's a fixed mortgage, usually, than you would with a adjustable or variable rate mortgage.
And
Uh,
those penalties are worth paying attention to because they can be steep.
Certainly, far too many people just look at the interest rates, and interest rate is important, of course,
Yeah.
but usually you're talking like, $10, $20 a month in difference in payments. But the difference in the prepayment penalties can be in the thousands. easily in the thousands.
Yeah.
So
Yeah.
yeah, you especially want to pay attention to that. An adjustable rate mortgage, you're looking at anytime they well, you have to be careful here because it's usually the Bank of Canada rate, but sometimes it's the lender's rate, which is often the same as the Bank of Canada. But some of the big banks have their own prime rate, which is actually
Yeah.
half a percentage higher
Yeah.
than the Bank of Canada rate. But anyways, you get usually a discount from the bank's prime rate or the Bank of Canada's prime rate. So for example, it could be prime minus 1% as an example. And basically, if prime is 5% and you've got a discount of 1%, your interest rate is 4%. So with an adjustable rate mortgage, as soon as the prime rate changes, then your payment will change.
Right.
A variable rate mortgage, it's a little different in that your payment remains the same, but not always. So
Yeah.
your payment will remain the same until you end up with the situation. So when the interest rate goes up, you're paying more interest and less principal, but the monthly payment remains the same until you get to the point where the amortization is usually beyond whatever they say is acceptable. So that could be
Right.
30
Right.
years. Once the amortization goes up beyond 30 years, they might raise the amount you're required to pay monthly. So that's often referred to as the trigger rate when that happens. So yeah, there you have it. That's I think that covers most of the different types of
The major
mortgages
ones, yeah. And
for.
and so it's kind of what's kind of really neat there is that you know, to see those different financing options so people know that they do have options. And the other really interesting thing that comes through there is that the interest rate, there's still room. There's still room to, I don't want to say manipulate, but there's room for you to have a variance in the interest rate. It's not as cut and dried always as a major lender would tell you. And I will end it with this. That's why it is really important for people to come and work with an actual mortgage broker so they get all those options, which we've covered the reasons for that in another video. But just a plug, come to us for the mortgage broker aspects so that they're getting all those options, not just the one or two options that any one lender may have. So we have something like, I think, well over 70 lenders by now. And you've got some great packages all the way across. So, Rick, thank you so much for that, for answering that and clarifying that. You have an awesome afternoon, my friend.
My pleasure. Thank you,
Take
Sharon.
care.
Have a good one.